Where are you in this debate with the Federal Reserve, and how do you look at it through the prism of Asian investing?
I think from an Asian investor's point, it's about China. But going back to the US, we would see rates going to 5% next year. I think the problem in the market at the moment, if you look on the sort of work function, is that the market is still factoring in rates to come down in the sort of second half and fourth quarter of 2023. And I think what Powell said the other day, it makes it pretty difficult to do that. And it's all about the wage growth and the employment numbers. I mean, it's one thing everyone's got wrong is this pickup in employment, and it's so stubborn. Now, whether it's COVID related, whether it's structural, a lot of people retired, whether people have got too much wealth over the last couple of years in the US, but it's a problem. Maybe companies are doing more social service in the US and say we're not going to cut people, just because things are going to go through a downturn. Maybe we're looking for the long term. Maybe it's so difficult to get good talent in the US that they want to keep the longer people, and they're prepared to take on and lose a little bit of profit on that. But it's very stubborn, and until the Fed will not cut, in my view, will not pause until you've got payrolls on a negative figure or you've got unemployment up about 4 or 5%. And we're a long way from there. The market will factor, the market will flip on the next figure, but it won't be, it will be a bear market rally, or it will be a tactical rally or a tactical sell-off. It's not, we have higher rates for longer, and that's what we've got to live with.
If we get, let's see, NFP, it's a miss or a beat, what's going to spark the bigger reaction, do you think? I mean, is good news still bad news for these markets?
I think the problem is for the Fed, we've not had that much bad news on the economic data. I mean, the US economy, yes, we're all factoring a mild recession, but, okay, we had some pretty bad earnings reports on some of the companies, but they weren't disastrous. They were just lower than people thought. You're still showing that the US economy is in pretty good health. Yeah.
That's the problem, CPI.
CPI, yeah.
As we speak, you mentioned it's all about China, right? Hang Seng Index is up 5% now.
Yeah.
I wrote about this on a terminal earlier on. I mean, if you make a bet, who pivots first, China on COVID or the Fed on inflation? China's probably the bet there. Would you agree?
I would definitely. I would definitely agree that China will change. Well, maybe we don't get COVID zero policy ending before the Fed stops. I don't think it'll pivot. I think pivot will be 24, but we'll definitely, in my opinion, get a roadmap in China that the market will start to factor in. Yeah. Hong Kong is the most volatile market in the world. I mean, I used to, I've covered all the emerging markets for many years. I mean, I used to look and worry when I woke up in the morning in Asia what was happening in Latin America. Now that's quite calm. even going through an election. Hong Kong is an incredibly, sensitive market. The rumours, beginning of the week, rumours that they might open up.
Yeah.
People very disappointed, obviously, after the CPC. Maybe they misread the CPC, but the market sold off. International investors getting out of Hong Kong, getting out of China, structurally, apparently. And then suddenly there's a rumour that the markets are going to open up. And what China needs is confidence in the consumer. It needs COVID zero roadmap, and it's not going to happen overnight because we know the medical situation. A lot of the elderly are not vaccinated. We had the same problem in Hong Kong. That's now been largely resolved. There has to be a roadmap in China to get out of COVID zero. It's not going to be a switch, but once we're more confident of the roadmap, people in China will be more confident. People are saving money. Saving rates in China are higher than they have been for 2 years. The corporate's not spending money. It has no confidence. Those have to change, and the only thing that can change it is COVID zero. Look, the housing doesn't help. The US politics doesn't help, but COVID zero is the only thing that needs to change to get some sort of delta in the economy.
Just one word there about the US and about jobs. I mean, the job market's held up, but job cuts are increasing. I mean, look at Twitter, look at Amazon. Apple's not hiring at the moment. Lyft as well. These are all shedding staff. I mean, we had one company announcing that they were looking at job cuts and job cuts announcements. They're up 48% year over year.
Yeah.
So, I mean, there are cracks appearing.
No, there definitely are. But we got to a situation where 2 months ago we had 3 jobs available for every one person looking for the job, and now we got to a situation where we have one job seeker for 1.4 times jobs. So we just need to adjust. But the wage growth is important as well.
It sounds like are you turning a little bit more optimistic on China? I mean, is it hard to stay underweight in this market now? And is that the best alternative right now in these volatile markets?
Our last note we wrote, we said patience is needed before the CPC. If I'd written a note the day after the CPC, I'd say more patience is needed. And we have to work out what the longer term implications of the CPC are in terms of common prosperity, in terms of housing, in terms of self-sustainability. But short term, it's really dangerous. Look at the market.
Yes.
You know, you can't, being underweight is dangerous, basically. And look at the market on a rumor. What's going to happen when, you know, we haven't called it yet. When it actually happens. I mean, you know,
better travel than arrive.
I would not, you know, I would expect in the next 6 months, it's so difficult to time, yeah? So don't hold me on the timing.
Yeah.
But in the next 6 months, we'll have a 50% rally in China.
Wow.
Now, whether you sell into that or not is another matter, whether it's structural, but there is look how well the market's done. I mean, that will only bring you back to sort of August levels. You know, I mean, we've had a derating of the Chinese market since February 2021. We've had, you know, stocks that are good businesses that probably were overpriced, like most stocks because of rates coming down, that now are trading at very, very low levels. You know, obviously the profit outlook is more difficult because how much the government's going to take, but there is so much pent-up demand. Yeah.
Well, two things if you're a longer-term investor, right? You look at valuations, and I mean extremely low in China. So I think when you look at that, can we expect, in terms of the earnings capacity of these companies, the longer-term trajectory of the economy, will those multiples return back to trend? And also what that means is, I guess, the other part of the Fed, if inflation remains at, say, 4 to 5% over the next 2 years, what does it mean for what multiples should look like?
Well, that's two different questions in that way, David, because global multiples will be lower, okay? You know, we won't have a top on the S&P at 22, 23 times. They've got to be at sort of 17, 18 times. But in China, I do not think we'll go back to the multiples we had before, David, for two reasons. One, I think the earnings environment, given the housing, given that we're going to have lower economic growth in China, lower trend growth.
Yeah.
We're probably going to be 3 to 4 going forward, which is fine if the quality is high, but it means lower earnings generally as a market. Now, there'll be some sectors that grow out of that.
Yeah.
And I think we're going to have the risk premium being higher because of geopolitics, because of the US relations and because of Taiwan. But saying that, China is extremely cheap relative to history. Emerging markets are extremely cheap relative to history. You know, we're looking now at emerging markets being a real discount to the rest of the world. But emerging markets, you know, the big question is there, can they run without China? Yeah. And a lot of it's to do with the dollar and the Fed pause. So, you know, at some stage next year, if the Fed pause, if the dollar starts to weaken, emerging markets ex-China will do incredibly well. The cyclical side, the Brazils, etc., the ASEANs. But China itself, to me, is all about what's happening in China, not the rest of the world.